Good evening, everyone. Time for another silver update. This is the 2-hour chart of silver provided by netdania.com. You can click on the link below. And I've drawn a number of things in here. The main thing we want to concentrate on is the reset or oversold position on the MACD, which I've been covering. You can see when we draw a trend line here for the MACD that we've actually broken down now below that trend line. And the big divergence that we're looking at, of course, is this breakout here, which corresponds with this price breakout, and then the current price that we're at. This downsloping line is the oversold line. You can see that the MACD is actually lower now than it was at this breakout, yet this uptrending line is showing you the divergence. So even though the MACD is completely retraced and is in fact lower than it was before we broke out, you can see that the price itself is really only corrected about maybe a quarter of that. So that's a big divergence, and that's the difference between this uptrending sloping trend line and this down sloping trend line. Now that's going to resolve one way or the other, of course, and it could resolve to the downside. We've seen something similar before. If we draw a line up right about here, which is where we were approaching the rally in the past based upon this uptrending line, you can see we were approaching a rally point when we had this significant sell-off here, and we broke down through and made this low here. So that's quite possible as we're going into tomorrow, which is going to be a big Fed speak day, that we could break down dramatically and go down and test. The first test, of course, is going to be right here at about 30 bucks. So that could happen. Or, on the other hand, we could see a rally and we could see this MACD from its already oversold position begin to rally, and then we could take off and go into new highs. A lot of this is going to be based on what Bernanke is perceived to say. You want to watch the 8:30 open in New York. That's when very large volume comes out. I don't know what the economic reports are going to be, but normally you can see the New York boys either jump on the price of silver right there at 8:30, or sometimes they jump on it and it rallies back and then they hit it later. So we'll be watching the price of silver very closely tomorrow, and to see how it reacts to whatever news that comes out. Now I want to jump over to the question of the night. I have a number of questions, but I really only have time to cover one, so we're going to cover this one from Snow Rider. This is a sign of the end of manipulation. John, in the history of the silver price, I have never seen a one-day, 24-hour period of time in which silver has ever seen a multiple dollar advance in price. All during the 2011 run-up to 49.87, there was never a day in which silver rose above $2. However, we saw a $6 drop in 10 minutes. Will the days when silver advances several dollars per day be a signal that the manipulation is either losing its power, or at least temporarily shut down, or actually over? Thanks, Snow Rider. Well, if you have followed these markets as long as I have, you'll remember the $6 gold rule. I might not be able to pull that up for you here because it actually may not go back far enough. I think GATA originally pointed that out, and this only goes back to 2009 on the daily. But the rule was that a lot of people noticed, in fact, it became so conspicuous that traders began to trade it. And the rule was that gold never rises more than $6 in one day. And if it rises more than that, then it's sold down to that. And now you can see if we go in and examine, I think we want to do the information window. If we go in and examine the prices on gold, you can see that, let's expand this a little bit. You get the high, low, and close. So if we zoom in a little bit, you can see that there are plenty of days that violate that rule. This day here, you can see we had an open at 1348, a close at 1386. So there's nearly a $40 run. So obviously, once that $6 rule was cast aside, then all bets were off, and of course we're moving in much larger multiples of that $6 now. I believe it was somewhere around in here. This is a weekly, so it's not going to give us the figure, but you can see that the open was 504 and the close was 525. Not sure when that $6 rule stopped functioning, but it did eventually stop functioning. So the same is going to hold true with silver. Of course, the moves down are always more dramatic than the moves up, but if we go to the daily, you can see that probably the biggest daily move up we have would be right here. Looks like an open of 36.21, a close of 38.47. So that does seem to violate that rule, but that may be looking at different prices. So as we expand, the volatility expands, and once we start the next up leg, it's my opinion that you'll start to see moves like these daily moves here, like down moves, such as $6 in a day, $2 in a day, $3 in a day. That's going to happen. It's just a question of when it's going to happen. So let's jump over to the story of the night, and of course that's the latest Jim Willie. There's so much here that it's impossible to cover it all, so I'm just going to read from the beginning into the main point, and that's going to be Morgan Stanley, because Jim is predicting a very soon to be arriving blow up, and so let's read that real quick. Begin with a preface to a meaningful event that could change the entire U.S. landscape, a redux of what happened 4 years ago. Consider the next Wall Street financial firm failure. It is in progress. It is not avoidable. It will have numerous ramifications. It will open the door to account thefts, the burial of documents, the ransack of undesired leverage positions, the concealment of wrecked derivatives, and a path toward the merger of surviving selected core firms. It will urge an extreme defensive posture. Back in 2008, both Bear Stearns and Lehman Brothers fell. The former because they had too much gold exposure with anti-US dollar hedges. The latter because they led in mortgage exposure. Both failures were greatly exploited. My favorite item was the reload given to J.P. Morgan on a quiet Saturday morning, convened at 6 a.m. no less, at the Bankruptcy Court of Manhattan. The shadowy syndicate titan was handed $138 billion to handle the private accounts from the fallen banks. Instead, the funds represented a reload for J.P. Morgan to continue their gold suppression game. Of course, they have been defending American freedom with vigor, preserving the integrity of the U.S. banking system and assuring the way of life in the nation, while leeching $1 billion from the public trough. Since their grant, the unassailable J.P. Morgan has seen fit to gobble private accounts at both MF Global and PFG Best, with regulatory blessing as the courts sprinkled fascist holy water. In the background, across the globe, numerous currency storm centers have arisen under the noses of every major central bank and their elaborate connected paper factories. The sovereign bond foundation is full of cracks and rotten planks upon which the entire global currency system rests. The only people who could have imagined such a grand mess in 2006 and 2007 were the sound money crowd, the advocates of gold-backed money, the opponents to debt foundational systems. But then again, we are the nutballs without a clue who maintain a myopic view of the world and see a conspiracy under every rock. Rather, we are the insightful, the alert, the rational, clear-thinking bunch, the guardians against hidden confiscation through inflation, the intrepid defenders of life savings. We identify the corruption and thus are discredited. Gold will return to its rightful place as the core of monetary systems and trade systems all in time. The system is imploding at a more rapid pace with each passing month. Morgan Stanley implosion. The insider conversation, often called chatter when it when it becomes deafening in tone is that Morgan Stanley faces imminent failure and ruin. Almost 2 weeks ago, the jackass provided a tip to Bill Murphy of GATA to post on his popular Le Metropole Cafe that Morgan Stanley fund managers and high-ranking employees were preparing for the firm's implosion. A subscriber to the Hat Trick letter has a good friend whose father works as a fund manager and provided the story. It was not detailed and bore no follow-up after my request. The older employees are selling all of their stock, some legacy stock from 1 or 2 decades ago. Many workers are making contingency plans for their next positions in another firm. When Lehman Brothers was killed, thousands of employees had to find new jobs, some without success. In the last week, the shockwaves are being heard from internal Wall Street sources in an unequivocal manner. The implosion is in progress, like the collapse of several platforms and structural cables. The inside is caving in, and the ranking members recognize it, even talk about it openly. Much discussion swirls about a transition to antiquated software that is greatly disturbing the trading desks, causing tremendous problems at precisely the wrong time. A redux of night disaster could be in progress. Some, like Rick Wiles of True News, report that Morgan Stanley is heading for the sacrificial altar. Such an event would imply an unexpected benefit hoped for and beseeched. My view is in parallel, but more of a harmful implosion that cannot be prevented, one that the Wall Street titans will face grand challenges to control, one they will not be able to exploit in the hidden corners where they operate. Morgan Stanley is going to the slaughterhouse, not the altar. Its implosion will result from lost control, and the reversion to antiquated systems will only hasten their demise. Wall Street will wish to exploit the failure. Like stealing funds, like destroying documents, like concealing derivative positions, like receiving government slush funds for slimy patch projects, their usual modus operandi. In criminal parlance, they will create a black hole into which things vanish. They will attempt to add to the confusion, which might itself backfire and deliver more lethal challenges to the entire U.S. dollar and U.S. Treasury complex. This time, the spotlights will shine more brightly to reveal the activity in the shadows and crevices. The part that many analysts might miss is that Morgan Stanley has perhaps over 300,000 private stock brokerage accounts with over 17,500 brokers. In the past 2 decades, Morgan Stanley merged with Dean Witter and Smith Barney to become the premier stockhouse with the most private accounts of any U.S.-based stock brokerage firm. The Morgan Stanley failure might feature the first theft of private stock accounts. The critical jump might occur in account thefts from futures brokerage to stock brokerage, which began in November 2011 with MF Global, then appeared in July with Peregrine Financial Group. All private accounts from MFG and PFG have been pilfered, with the blessing of the theft by the courts seen in the Sentinel Management Group ruling. The Federal Appellate Court's August ruling sets precedent for future private segregated account thefts, which were once considered sacred and untouchable. No more in the United States, not in the unfolding of criminality that stretches from U.S. government offices to top corporate offices, with blessings sprinkled by the courts. So you can see here that the U.S. is rapidly becoming a banana republic. All the hallmarks of a banana republic are there. Utter corruption in the legal system, the banking system, government system. It all becomes corrupt, and everything is subject to bribes. The jump would be a major extension of the fascist business model that nobody talks about. The major financial firms can rely upon this appellate court ruling as precedent so as to protect their legal right to rehypothecate client funds in their high-risk leveraged positions and loans. It sure would be nice to use my neighbor's house or car to firm up my casino weekends. Stay tuned to the ongoing Morgan Stanley implosion, which could force the vanishing act of 50 to 100,000 private stock accounts. The firm is the largest stock brokerage firm in the land. The dreadful impact will be nasty and might awaken the U.S. masses. MF Global and PFG Best surely did not. So that's Jim's projection for a Morgan Stanley implosion. If you've listened to Mannarino lately, he's been talking about the stock charts on the banks and what they're forecasting. If we pull up the big charts, stock chart of Morgan Stanley stock, you can see that we go from this high of about 75 bucks almost down to where we are today. So yes, we cratered during the financial crisis, and you can see in the fall of 08 it took some dramatic intervention to bring Morgan Stanley back from the brink. They were about to penetrate that $5 price and clearly were on their way towards bankruptcy, but it was staved off. We got a big rally, followed up in the rally of the spring of 09, but really topped off in 09, and it has been in decline ever since, unlike other stocks such as Apple or Priceline or others that just rallied and have gone straight up from there. So Morgan Stanley is continuing that decline. If we go to this chart here, you can see I've overlaid Morgan Stanley with silver, and you can see silver in the blue here has pretty much just risen in this straight line fashion, while Morgan Stanley has declined pretty much in this straight line fashion. So the prices have crossed over. At one point back in about 2000, you could have sold all your Morgan Stanley stock and got $110 a share, and you could have picked up silver for under $4. That happened a little bit later. So what a tremendous trade you could have made. Now we've got Morgan Stanley at 15 and silver up at 30. So you can see the trend is very clear. The paper is burning and the real thing is rallying. Now I wanted to take you to some more information about Morgan Stanley. Let's start off with the key statistics here. You can see one big one that jumps out at you from Yahoo is if we look at the enterprise value on Morgan Stanley, it's negative $185 billion. The market cap, of course, is about $30 billion. That's the value of all their publicly traded stock. The rest of these figures are hard to put any kind of meaning to. You can see that the revenue is about $30 billion, but the quarterly earnings growth are down 50%. The total cash is described as $600 billion with debts of nearly $400 billion. So I guess according to that, they should be to the good, but apparently they're to the bad. So it's really hard to make anything of these numbers. They really don't mean much. You can see total debt to equity is 528. So that's just an insane amount. There's really no way to calculate this. But I did want to take you over to the options activity for Morgan Stanley. This is the straddles, and we're looking at the month of September. So a brief options course for those of you that don't remember the ones I've done in the past. Open interest, of course, is the total number of outstanding contracts for that particular option. Now, remember, stock options are not like futures options. There do not have to be a matching number. So, whereas in the futures, you always have the same number of longs as you have shorts, there's always an offsetting position. That's not the case in stock options. You can have offsetting positions in other strike prices in other months, and they don't have to necessarily offset at all. So you can see the open interest for the options, the call options in September. You got a very large open interest of 112,000 for the 17s. The price, Morgan Stanley's under 15 right now. Then, of course, the volume, that's going to be the percentage of the open interest that traded that day. You can see with the call options that we have very large open interests here. You can see this one, as I said, over 100,000 with only 145 options trading. Now, on the other side, when we take a look at the put options, we don't have nearly as large of an open interest, but you can see that apparently either Jim Willie is onto something, or a lot of people are just happen to be trading, and it's a big coincidence. But if you look at it here, you can see the volume. Now this is the nearest month out, so these are the September 2012 options. They expire the 21st of September. So this is forecasting some very serious fireworks apparently in the near future. So you can see 11,717 of the 14 puts traded today. They're about 24 cents. That's the equivalent of 24 bucks an option, and that's again the September strike. So we're about, that's the 14 put, so we're 90 cents away from that price target. So a lot of people apparently are willing to bet a lot of money. That's going to be 11,000 times $260. So you do the math. You can see we also had a big volume here relative to open interest on the 13 strikes, and a decent amount of volume on the 12 strikes as well. So let's move out further in the straddles. As we go out to October, we have 5,000 of the calls. These are the 15 calls, and you can see we're at about 15 right now. So this may actually be the offsetting action for some of that other action. A lot of times they will hedge themselves in other options. So if they sold puts, they may buy calls just to hedge themselves. You can see in this month we have very decent sized open interest, about even. You can see that except for this month, except for this strike of 17, with 95,000 open interest on the calls, only 6,000 on the puts. But otherwise, things are fairly even, and we don't have much activity. So let's move out to the January 13. These are the leaps. These have actually been in existence for quite some time, but we really don't see a lot of activity. We have one 5,000, probably another hedger, 1,000 here that traded of the 15 puts. And then we've got April, and again, not a lot of action in April. Somebody picked up 200 of the 10s, and that's really not a lot. It's not until we get out to the January 2014 leaps that we see some interesting activity here. First of all, we've got a very large open interest in the 13 strike put, and we've also got a very large open interest in the 15 strike put. This expires all the way out at January 17th of 2014. So you've got a good year and almost a half for those options to play out. Clearly someone made a very big bet here today on this play. You can see 2,000, and the price of this is about 200 bucks. I misspoke on the other one. It wasn't 200, it was 24. So this is about 230 bucks for this option times 2,000. So you do the math. Almost a $500,000 bet, apparently, that Morgan Stanley is going to be at least to break even on this. They paid $2. They need Morgan Stanley to be below 11 by the 17th of January 2014. So clearly the largest amount of activity is going to be in these puts, strike price of 14 and 13 and 12. Big activity. It appears that Jim Willie apparently is onto something, and we may have a big firestorm coming soon with Morgan Stanley. So back to the silver chart, we're looking for a large move to the downside, assuming that the cartel steps up and smacks down silver based upon the Bernanke speech tomorrow. Perhaps we will see a statement that there's no easing or QE forthcoming, and we'll get a big move down. We kind of had a foreshadowing of that today with a move down in crude, move down in stocks, and a move down in the metals. We may have very dramatic follow through tomorrow. Or then again, we actually may get an announcement of some type of QE, or at least a hint at that, and perhaps that might be what the silver price is signaling with this very large divergence between the MACD and the price. And we'll talk to you next time.